This is a long-term graph of the S&P 500 where earnings are correlated with stock price. The orange line represents the intrinsic value of the S&P based on its earnings achievements going back since 2002. As you can see, the blue line on the graph represents the normal price-earnings ratio. And lately, the S&P has been trading far above its intrinsic value or its normal PE ratio. We're starting to see that beginning to correct itself as we enter some real issues with the economy, war, supply chain, inflation, interest rate increases, etc. Hello, everybody. This is Chuck Carnevale, co-founder of Fast Graphs, the Fundamentals Analyzer software tool, bringing you another subscriber request Tuesday. I do want to talk a little bit about these subscriber requests because I want to make it clear that these are stocks that you, the subscribers, have shown interest in and asked me to cover. And as I showed in the beginning, fast graph here, the S&P 500, which measures the overall or general stock market, is relatively expensive. However, subscribers have come up with 13 stocks that I'm going to be covering in this video that look inexpensive. In fact, some of them look really attractive. Now, I do want to put out a caveat. I've not researched all these stocks extensively. This is preliminary research. This is just looking at each of these companies based on the numbers, past, present, and future, what the expectations are. But there's also a side effect here of going through a portfolio like this. It is a market of stocks, not a stock market. And in contrast to the market, many of these stocks are cheaper, but they also have much different fundamentals. Some grow a lot faster, some pay more dividends, etc. So I'm going to use this as an opportunity to illustrate how different stocks can be and also take a look at some stocks that you might want to take a further look at in your own portfolios, depending on your investment objectives. So let's go ahead and look real quickly at the portfolio. I've got 13 stocks that subscribers have requested. Okay, when I look at them from a standpoint of fundamentals, I have a choice from the material sector, the communications, two from the communications sector, the information technology, consumer discretionary, I got three of those, and industrials, a REIT in Omega Healthcare, another consumer discretionary, an industrial, and the communication services. So I've got a kind of a broad cross-section of companies here. And I'm going to go through these one at a time, just based on alphabetic orders, the way I've got this set up for you. And I'm also going to take this opportunity to point out some differences in the type of stocks that you're looking at, but also in what makes them different from other stocks. For example, the first one I'm looking at here is BERY Global Corp. All right, and I'm going to use this as an analytical tool. Fast Graphs is the Fundamentals Analyzer software tool. It paints a picture of the business behind the stock and then how the market prices that business. That's what's really powerful. But it does require interpretation. You've got to be skilled at using this. For example, I've got an earnings growth rate here of 45% in BERY Global, and that's just extremely attractive. However, that growth rate is heavily contaminated by the first year here where the earnings growth was 940%. So that obviously brings up the average of all these other growth rates. So the first thing we want to do is we want to take out that aberrant number. Now we're seeing a growth rate of around 21%. Okay, and we've got a PE ratio here of 21, where in the max graph, we're drawing it as a PE ratio of 45, where PE equals the growth rate. However, the growth rate changes, and so therefore does the valuation reference. This is probably more representative of how this company has grown historically. And we can see the market puts a normal kind of a market-ish multiple of around 15 times earnings. The actual normal PE calculates out to be 15.53. That's the blue line. And what you see, that's probably right now, if I'm analyzing this historically, and this has only been a public company for a while, the most representative valuation reference that I can hang my hat on, kind of a 15-ish PE. There were the first 5 or 6 years here, it traded at PE ratios above that. Then it traded right on that 15-ish PE, and more recently, it's been trading at a significant discount. But I also want to point out, as I shorten the time frame, the earnings growth is changing, and that's how I'm using this tool. I'm looking at what's happening. So I've learned a great deal from the past. This has been an exceptional growing company, obviously. It's had tremendous growth rates. That growth rate is slowing down as I move along into more current years, but it's still above average growth. Now, the stock is very inexpensive. It's trading below its normal valuation range and its intrinsic value range. But let's look at it from a futuristic point of view. Analyst estimates, the consensus of around 18 analysts, are expecting a 15% growth rate. All right, now notice that the earnings growth of this company over the last 6 months has gone from 634, then it went to 745 3 months ago, and now it's currently expected to earn $7.25. So the number is basically its increase and then its decrease. So it's hovering around that $7 range. It's probably realistic. If I use that normal multiple of a 13 PE ratio for the past 5 years, that's actually lower than the historical norms, I still have a tremendous opportunity if I believe the 15% growth rate. I would have the opportunity to more than double my money this year. And, over the longer term, maybe average as much as, 30 to 35% a year annualized if this stock trades. Now, if I'm looking at what I would call a realistic 15-ish PE ratio, that number could even be higher. So this is a growth stock. It's aggressive. It's only double B plus rated. One thing I was asked recently by a subscriber is, how much credence do I put in credit ratings? I like investment grade credit ratings, but if you're looking at a riskier growth stock like BERY Global, it might make sense to, ignore the credit rating. The company does have a lot of debt, 74% debt to capital. So, you want to take that into consideration. But you would want to go through and research this stock a little bit. And I just want to address that just briefly. I've set FastGraphs up to be able to go directly into the company's website, for one thing. That's always a good starting point, in my opinion. And I can go in here and I can look at the various products that the company has. And I can choose a product category. They got apparel applications, applicators, like underarm deodorant, bags and bulk bags, bottles and vials, building materials, canisters and jerry cans, caps and closures, containers, tubs. So, it's basically a diversified company that's considered metals and glass containers by the industry or the sub-industry classification. So I would look at that, and then I would go into other places. I'd go into Morningstar. I'd go into maybe sites like Seeking Alpha, which gives some crowdsourcing information on the stock, and I'd be able to look and see what other investors are thinking about the company, some professional, some lay. I would go into, other sites like the Wall Street Journal. I would spend a lot of time in the company's own website looking at their financials. So I'd go to research this, much deeper before I ever made a decision. I wouldn't just automatically base it on these estimates, but I would also check the analyst scorecard. In this company, excluding COVID, which obviously impacted a lot of people, it has a really good analyst scorecard. So what this tells me is analysts have been able to get this right, which also tells me that, the company probably guides these analysts realistically over time. Now, consensus estimates are never perfect. All you can hope for is that they're reasonable, but there are risks and there are pluses and minuses here. We've got a lot of upside in virtue of PE ratio expansion potential. We've got growth potential, no dividend to buffer any of our mistakes, in thinking if this doesn't perform according to what expectations are. But it is an interesting situation, and a lot of the risk that would be associated with this stock is already, factored in by the low price, and that's something else you ought to consider. Now, this one is very interesting. I want to spend some time on Meta Platforms, aka better known as Facebook, because this is something that's very important when you're dealing with growth stocks that you also always have to keep in the back of your mind. Okay, this is currently a 589 million market cap company. All right, it doesn't have a credit rating because I haven't applied for one, but it's obviously a formidable company, generates very strong cash flows. Its debt to capital is very low at only about 9.5%. But the company's kind of going through a transition. That's why they changed the name to Meta Platforms, because they're looking at the metaverse, this new artificial reality, if you will, platform. So Historically, the company's grown by 30%. But once again, when you're dealing with growth stocks, I think it always pays to change the time frames. Now we're still looking at 30% growth. I go to the last 5 years, which includes these forecasting years, and my growth rate is cut in half to about 15% now, 15.3 to be exact. Okay, I look, a little closer. What the forecasts are is only about 6 or 7%. So the forecasting in this company for the next couple of years is only 7%, but you want to look past just the number here that you're looking at and analyze this. They expect this company in transition to have negative earnings growth this year of about 10%, they being the analysts, of which there are 51. And notice that the estimates have continuously come down this year from $16 expected 6 months ago, when it was $14 about 3 months ago, and now it's $12.36. But looking out, it's 17% and 15% for the next 2 years. Long-term growth rate is expected to be about 12.9%. Now, another thing you can do, these are estimates that we get from FactSet, which is a data provider that we use. However, I've also put in here a link to Yahoo estimate data. Yahoo gets their estimate data from Reuters, so I can go look at Yahoo. Yahoo says 18.5%. Okay, so I could go into the custom calculator here, and I can, the analysts are saying 12.9. I can go in here and put in my 18.5, and I can run different what-if scenarios depending on what I believe and what I think. Now, the company looks very attractive based on an 18% growth rate going forward with a blended PE of only 15. That gives you growth. It gives you some PE ratio expansion potential. But once again, no dividends, out here. But keep in mind, the company's growth rate as it got bigger has slowed down to more realistic numbers, something closer to what the analysts are currently forecast. So you learn from the past when you look at a company, a growth stock like this, but you want to be realistic, or try to be as realistic as you can in what your assessment of the future growth is, because you're only investing in the future. The past is the past. And if you didn't own the stock during this period of time, you can't invest in it. Now, again, the price has fallen dramatically. A lot of controversy going on with big tech, censorship, et cetera, et cetera, et cetera. So there are a lot of issues here, and they are transitioning into some, going in some new directions here, but you want to basically take a hard look at what you think the future might be for Facebook or Meta platforms now, as they're called. Another behemoth here is Google. And once again, I'm going to go through this one a little quicker. You have this enormous growth rate over, going back to 2004, over 37% a year. But as you shorten the time frame, the growth rate drops to 20% when I do 17 years, which includes, almost 3 years of estimate data. So we'll say 14 years of history. If I go into my 12-year number here, the number's now down to 18%. For a company that's $1.7 trillion in market cap, even though it's AA plus rated, that's pretty formidable growth. Now, as I continue to shorten this time frame, I'm sticking around that 20% number here. But then I go into the forecast. Analysts are expecting that to be about 11%, and the long-term growth rate is expected to be about 14%. That would tell me that this stock is overvalued based on its future expectations, and somewhat explains why the stock has been weak over the last year or so. It's been being valued on its reputation, so to speak, in the past, and it looks undervalued based on that. But if you're looking realistically to the future, and keep in mind, estimates have increased a little bit on this company in the last year. And if I look at the analyst scorecard here, it's pretty formidable. It's pretty excellent, given some margin for error here. So, Alphabet, aka Google, could be slightly overpriced here based on, expectations of the future. So you want to take that into consideration when you're analyzing the stock. The next one that subscribers asked for was global payments. And one subscriber pointed out that I covered this in last November, and the stock price about back where it was. That leads me to want to address this idea of volatility. All right, now before I do that, the company's investment grade is BBB minus, has 31.3% debt to capital. So it's got, reasonable, debt to capital. It has a tremendous growth rate of about 18%. And if I shorten the time frame here, it's been maintaining that 18% growth rate. It's forecast to continue to grow at 16.5%, which is pretty close to the 18% growth, and 16.6 on the long-term growth. So Global Payments is expected to continue. They've recently started paying a dividend. They were paying a real slight dividend in 2016. They've increased that. They have a low payout ratio of barely double-digit payout ratio, so there's a lot of room for the dividend to grow. It's less than 1% now. The blended PE ratio is 15.9. Earnings yield is 6%, which is okay for a company that's expected to be a pure growth stock growing at a rate faster than 15%, because that means that the future earnings, price earnings ratios, the forward earnings price ratio, if you will, is lower. So I think nothing's really changed. One thing I want to point out, I often tell people that when I'm looking at companies, I take the prices off. I'm really trying to assess the fundamental strength of the business. Now, in the long run, the market prices it according to the earnings growth. And you can see that very clearly when you bring in price. The price tracks earnings, but it does occasionally get disconnected. And then, during COVID, for example, we had this flash crash. It became reasonably priced, then got overly optimistic again, and then it's come back into fair value, and it's trading in that now. But the point is, whether it's trading at the same price it was last November or not, to me is irrelevant. The key is, what's it going to do over the next 3 to 5 years? That's what I'm always looking at. And based on this, I've got a good double-digit earnings potential as far as earning my rate of return by investing in this company. I don't consider it a screaming bargain, but I do consider it fairly valued in this overvalued market. And I do consider it a very attractive company with reasonable levels of debt. I would also, go much further when I'm analyzing the stock and look at cash flows. Cash flows are covering the earnings. I also would like to look at it as a price to sales. It looks a little expensive based on its recent sales growth. But again, valuation is always a puzzle. You go through all these different metrics and you want to go deeper into the company, start researching the stock. But this one looks worthy of further research based on the valuation you can buy it at today. The Gap is a very interesting company. It's a really cyclical stock, if you will. COVID, because their stores were in malls, they had to close their stores. That obviously killed their business for a period of time. It's beginning to recover. Analysts are expecting it to recover. It's offering almost a 4.5% dividend, 4.4%. The company, has 61% debt, only has a BB credit rating. It is trading at less than 9 times blended earnings, which is very attractive. So a lot of your risk, again, would be built into the price. From a performance standpoint, the company did cut their dividend and, eliminate it almost totally, if you will, during COVID. But that was, to be expected. COVID was obviously a 100-year event. And so this one is not the kind of company that I like to be a long-term investor in. I consider it too cyclical, too volatile. Although if I was looking at it purely from a more speculative stance, analysts are expecting double-digit growth over the next couple of years, but those earnings estimates have been dropping. All right, and of course the analyst scorecard is going to be somewhat spotty compared to what I've showed you, because the fact this is a retailer, it is cyclical, it is hard to, make estimates for, but it does have statistics that could attract some investors. Over a 4% yield, a low valuation, earnings yield over 11%. But again, how much do you believe what is, showing as being expected to go in the future? LQK is a very interesting company. A lot of people aren't familiar with this company. We go into the company, it's auto parts and things like that. The company has, been a very strong grower. It does have a global presence. It's not really well known. Again, it's a pure growth stock. It does offer a, modest dividend yield. This is one that I think is inexpensive, but keep in mind it's expected to have a down year in earnings here. So, that's obviously factored into why the price is currently dropping. It isn't expected to grow very fast in the future, but I think you're buying the stock cheap enough that you could see some PE ratio expansion, and you could, see an opportunity to make nice rates of return going forward just based on the valuation. But this is one where you've got to look past the history and look to the future again. I think that's so important. I want to reemphasize that. Here's Lazy Boy. Lazy Boy was really a very poor performer between the last two recessions, that we've had, the recession of 2000, 2001, which, caused the stock to go down. It rallied pretty good. Then we had 4 or 5 or 6 years of bad earnings, so it was really cyclical. Notice how the stock price tracked those earnings. That's something important. Fundamentals matter, and they matter a lot. But then if you're looking at more recent years here, the company's really strung together a good decade plus of some really strong 14% growth. They did, obviously get hit during COVID. They are a retailer, home furnishings, the Lazy Boy chair. The stock got very inexpensive. That was a great opportunity to buy it. Once again, be greedy when others are fearful when others are greedy. When the stock got expensive, that would have been a time to get out of it. Any of these times you can see when valuation's high, that usually leads to poor performance. When valuation is low like it is today, that usually leads to some, really good performance. The company does pay a dividend. It's been paying a dividend since 2013. That dividend has performed, pretty well other than COVID. And, it's been growing, potentially capable of growing again going forward. Here's where you'd want to take a hard look at cash flows if you were interested in investing in this company. And I'm not so much interested in the price to cash flow as I am whether or not the cash flows cover the dividends or not. And, in this case, in the case of Lazy Boy, they absolutely do. I think the key here is that the stock is trading at a very low valuation relative to double-digit growth that's expected over the next couple of years and over the next 3 to 5 years as well. So this is really, the risk associated with the stock would be built into the price in my view. And, you can buy it at a very attractive 9+ times earnings, blended PE, a 2.5% dividend yield, with the potential to get growth, price earnings ratio expansion, etc. So Lazy Boy, looks interesting now, and they've done a pretty good job over the last decade. If you look at the analyst scorecard, it's been somewhat spotty even over the last decade. So again, retailers like this can be difficult for these analysts to estimate. I think you want to take into consideration what the analysts have been thinking. Estimates have gone from 320 to 362, and then the most previous estimate was 362, and then it's fallen to 295, which partially explains why the stock price has fallen as well. As expectations drop, people's expectations usually follow. So that's something to keep in mind, but I do believe based on the earnings growth that the company is expected, going forward, that the company still looks like an attractive investment going forward. All right, so that's Lazy Boy, if you will. Owens Corning, another company in the building materials sector. You can see the relationship between earnings and growth. Somewhat cyclical, but I wouldn't really call it a deep cyclical. It's got a decent dividend record. The dividend's grown by about 8% a year, and it's grown steadily over all these years since they instituted a dividend, or first instituted a dividend, back here in 2014. The stock is very inexpensive right now. It's not done well the last year. I consider it very, very attractive. This is one that I might want to take a closer look at myself for total return portfolios. It does offer, with a normal PE of 15, which I see no reason why this stock shouldn't trade at a 15 PE ratio. As this PE ratio on this graph is mirrored to the growth rate, or 15.78, and you can see that it's traded at that kind of PE ratio or higher most of its history. So I see no reason why it shouldn't get back there, especially if it continues to grow at around 9.5% or 10% like analysts expect. Once again, the analyst scorecard here's a little spotty because of the cyclical nature, but it's not bad. Even when they've missed, some of the misses have been kind of bad, but otherwise they have. Anyway, here's Owens Corning. It's a BBB rated company, 41% debt, so I think that's reasonably attractive. It's fiscally, healthy, if you will. Now, this one is a mega healthcare, and when you look at REITs, it's a REIT. You want to look at operating cash flow. This stock is down. The last time I checked it, it was down relatively big today. It was down 4 or 5%. A subscriber, called us down 3% right now. The company has had some trouble with some tenants. But this company is really a great demographic play for the long term. the risk associated with investing in this. They do have some tenants that are behind on their rents, but the company also, which isn't included in this data, one thing people forget is that when they sell properties, which they've sold some recently, that number is not included in these cash flow or these FFO numbers. And the company also has an opportunity to make a lot of acquisitions. This is a very fragmented industry. One thing that can be very helpful with companies like this, like, for example, the site Seeking Alpha gives you an opportunity to go look at presentations on the company. And if you look at what's going on in the presentation of this company, they give you a lot of information. They talk about their size. They talk about their management team. They talk about the growth through accretive investments. That's something that's hard to factor into these estimates. The company does have the opportunity to make a lot of acquisitions, and I'm going to show you a slide on that here, if I can find it real quick for you, where the fragmented nature of this industry means that this company has a lot of opportunities to make future acquisitions and grow, as well as a great demographic opportunity. So, this is something you want to take into consideration. There it is. Here's the slide. You can see this is Omega is the blue compared to the senior nursing facility ownership. There's, the green, including Omega, is the publicly traded, and these are the independents. So there's only 5% of the market is owned by Omega, and they've got tremendous opportunities for acquisitions. If you're thinking long term, with a 9% dividend yield, I think the dividend is still pretty well covered. It's getting pretty thinly covered, though. It could actually be due for a potential cut in the dividend. That's something to worry about. But there's a lot of room in here with a 9% current yield. And I think the valuation is extremely attractive, even though growth is not expected to be very strong for the next couple of years. I still like Omega as a dividend play. I think the odds are this company's kind of proud of their dividend record. I think there's a real high probability the company's going to do everything they can to maintain their dividend. I don't think it's going to grow. Rent-A-Center was another one I was asked about. Cash flow wise, it's pretty cyclical, pretty spotty. If you look at it from the standpoint of earnings growth, once again, it's a recovery story. You can see that the company's stock price tracks its earnings when it was going through the last recession or past the last recession. Recently, they begin to really get kind of their mojo on. Their growth rate has been very strong. I'm going to shorten that to where you get a representative picture here. I think this would be a better picture. This is since they've been paying a dividend, it's been growing at a very high rate, over 25%. Expected to have a down year this year, which again partially explains the pessimism in the stock price. It is expected to recover strongly in the next couple of years. Analysts have cut the earnings expectation almost in half this year. So there are some issues going on in this company you'd want to look at. But futuristically, again, just going back to a normal 15 PE ratio, this could be a very attractive speculation. Tempur-Pedic Sealy International, which, is famous for its Tempur-Pedic beds. I guess, you can see this long, history of this company and how the price has tracked its earnings growth so nicely. The company's now starting to pay a dividend about 1.5%. It's had a really good growth trajectory here the last several years. COVID interrupted the stock price advance a little bit, and now we've got, a slowdown expected in earnings after some really 3 strong years. So looking at this company going forward, it's expected to grow at about 11 to 12% a year. The long-term growth rate is expected to be 15.5%. The analyst scorecard in this company, again, has been somewhat spotty, is not unusual. When you look at the company fundamentally, it's only BB+, has 86% debt. So here's where you want to take a strong look at things like cash flows if you're doing the research. Right now, cash flows look like they're covering the dividend quite well, and even free cash flow looks like it's covering the dividend. Looking at this company from a price to sales point of view, it's trading back in alignment with its more normal price to sales ratio. So that's something that I think is also a plus on looking at owning Tempur-Pedic right now. It's, reasonably attractive. United Rentals is obviously, they call it a trading company and distributor. You see this really incredible relationship between earnings and price. The company's growing very fast, expected to grow at over 17% a year. You can buy it at a PE of 13.4. Earnings yield of 7.5, doesn't pay a dividend. This is a pure growth stock. It's BB+ rated with about 56% debt. That'd be something to be concerned about, but you can see that the company is trading at, I call this one fully valued here, maybe slightly undervalued. does give you a modest margin of safety, but a lot of that is based on the fact that it really has a strong growth rate achievement expectation. The earnings scorecard is extremely good. COVID was an issue, obviously, but I consider that, again, a 100-year event. Caused earnings to drop in 2020, but otherwise it looks real good. Verizon is a dividend play. I think the appeal here is we don't have a lot of growth. We have a really nice dividend, a really nice dividend record. Stock is expected to only grow about 2 or 3%, but you can buy it at under a 10 multiple. If it just expands to a 15 multiple, you could clearly have, 20% annualized rates of return over the next 2 or 3 years. And I want you to note that a 15 multiple, this is actually a multiple. The orange line here is 14.74. We'll call it 15 for round numbers. It's clearly traded at that or higher, most of its history. So I don't see any reason why we won't see it recover back up into somewhere in these next orange lines or so. And it would become a very interesting kind of a blue chip. It's, investment grade, BBB plus, does have a reasonable amount of debt, but Verizon does look very attractive at these levels. So there you have it. These are your subscriber requests for this week. I want to caution you again, these are companies that you have asked to see. I'm not necessarily saying these are what I recommend. Some of them I think do look very intriguing. I'll let you make those decisions for yourself and do your own research. But I also wanted you to get a sense on how to use a tool like Fast Graphs. You're analyzing the fundamentals. You learn from the past. You invest in the future. You got to make your decisions based on what your future expectations are, not what the past has been. But on the other hand, try to be realistic and use your common sense when you're evaluating these companies and take advantage of the dynamic nature of this tool. Draw different time frames, see what's happening to the growth rates. And there's a lot of other things you can do that I didn't show when I cover a lot of companies like this. But anyway, that's our subscriber request for this Tuesday. I hope you enjoyed it. I'm trying to cover as many stocks as you asked for. I always can't cover them all. I've got a kind of an eclectic universe here. They come in all different sizes, shapes, and flavors. That's one of the points I wanted to make with this video. Just because the market's high doesn't mean all stocks are high, and vice versa. Anyway, if you like this video, give me a like, subscribe to the channel. Take a look at Fast Graphs as a very, very powerful research tool for those of you to help you make future decisions. Again, I appreciate all of you and look forward to talking to you again real soon. Thanks for watching.